Hi, this is Eric Simpson, and today I'm going to show you a simple way to screen for stocks with a low PE ratio. What is the PE ratio? Well, it's the price to earnings ratio, or the market cap divided by the net income, or in per share terms, the share price divided by the earnings per share. Here's a little example. Company A has a price of $100. Earnings per share is $8. 100 divided by 8 is 12.5, and that's your PE ratio. Now, in general, high PE stocks tend to have high growth expectations, and vice versa for low PE stocks. And although it's based on earnings over the previous 12 months, lower PE stocks tend to perform slightly better over time. This is because oftentimes companies with high PEs or negative PEs, if they're losing money, tend to have growth expectations that are too sky high. And that's really common for hot tech companies or IPOs. You know, these companies that you hear about in the news all the time. They promise the world and they don't always deliver. So I'm going to test low PE ratio stocks and show you a way to screen for them. So I select market cap above 300 million to filter out a lot of these kind of super small companies that lack volume or liquidity, which are hard to trade into if you have larger accounts. And then a PE below 15, because 15 is kind of it's around the historical average for the S&P 500 PE. I think the current PE right now is in the 20s or something like that, but 15 is the long-term average. And I think anything below 15 is also considered low when you're using finviz.com. And that's a site I'm going to show you. It's a free site that you can screen with. So I want to make this compatible with Finviz too. So we're going to go to Portfolio 123 first. This is a screening and backtesting software. And I've already got the code set up here. So we've got PE excluding extraordinary items over the past 12 months below 15. I exclude extraordinary items like one-time deals or something that's going to affect the earnings unusually in a way. And then market cap over 300 million. The units are in millions, market cap over 300 here. Now let's go to the back test. Slippage is 0.25%. That's how much you lose on the bid-ask spread if you're just doing market orders and buying in. And then that's pretty appropriate for a company of 300 million market cap or larger. Our rebalance frequency is going to be every 52 weeks, so we're buying and holding for at least a year. That way we can incur the long-term capital gains tax rate, which is a bit lower than the short-term capital gains tax rate if we sell. The max period allowed in this software is 1999 until today, so that's almost 20 years. Today's September 2nd, so almost 20 years of historical fundamental data. And I feel like that's a very good period to look at because you've got two major market collapses. You've got the IPO.com bubble collapse in 2000, and then you've got the 2008 housing crisis. So now let's run this back test. And you can see right here, our screen, which is the red line, returns 12% per year on average. And then the S&P 500, which is the blue line, returns 6%. So alpha outperformance is about 6%. Max drawdown is pretty similar. So that's pretty good. Beating the market by about 6% per year. Now, does that mean if you pick stocks with a PE below 15 that they're definitely going to beat the market? No. I mean, there's probabilities, and although it's favorable, there's it's not 100% for sure, but it'll guarantee it should it should keep you out of trouble. It should keep you from selecting crazy stocks or companies that aren't making much money, and they're and keep you from blowing up your account or doing something stupid. And when you're getting into investing, one of the first things you want to focus on is not making major mistakes and not destroying your portfolio right off the bat. So now let's go to Finviz so we can do the screen of Finviz. And we can go to the screener tab right here. And then we'll do market cap. Let's see, plus small, so that's anything over 300 million in market cap. And then we'll go to fundamental, and we're going to select PE low, below 15. And here you have it. We have right now, as of September 2nd, 2018, we have 675 companies that fit this profile. You've got stuff like American Airlines, Aflac. Just search through here. Bank of Montreal, Berkshire Hathaway, Warren Buffett's company, kind of value focused there. So, you know, you've got these very safe companies which make a lot of money for what they're valued at. And they're not necessarily going to grow a ton, but, you know, if you pick a portfolio of like 10 of these stocks, these, you know, PE below 15 or low PE stocks versus a portfolio of 10 stocks with super high PEs or negative PEs, then the low PE portfolio is probably going to outperform over time. So yeah, that's about it. I hope you liked it.